So just a reminder that we are here today to talk about maximising tax claims for GPs right at the end of the tax year, and a good timely reminder of what you will need to collate for us for your tax returns for the year ended 5th of April 2024. So your presenters this evening are myself, Lizzy Lloyd from Larkin-Gowan, and Jamie Butcher, who is one of our tax gurus in the medical team. And there's some pictures of us and our contact details if you don't already have those. So tonight's presentation is really going to be about maximising tax claims for GPs. So we're looking at people who are self-employed in GP practice, but it will also be a helpful reminder for other self-employed individuals, but we're not going to specifically cover tax claims against employment income. So it won't really cover those who are maybe salaried GPs or hospital doctors, where the rules are ever so slightly changed. So there is a separate presentation coming up on the 17th of April, which Jamie will also be involved with, looking more specifically at the tax claims for hospital doctors. But there will be some overlap between the two presentations, so it's no problem if you want to hear them twice. So before we get into what you can claim to help reduce your taxable income and so your tax, thought it would be helpful just to set out the basics of income tax. So it's a real back to basics type course, this. So we first need to look at what income is subject to income tax, because when you complete a tax return, you have to put on all of your income, whether it's already been taxed at source, so it's employed, earned income, or whether it's untaxed like self-employed or partnerships. Other income which will be subject to tax will be pensions. So any pension you are receiving, state pension, NHS pension, again, that might have been subject or should be subject to tax when it's paid to you, still is subject to income tax and goes on your tax return. Interest on savings and investment income, there's another slide that covers that in a bit more detail, but basically taxable. Income from trusts and some state benefits are taxable as well. If you are in receipt of foreign income, say you've got a rental property in France or a bank account in India, if you are resident in the UK, that is still taxable in the UK, even though you may have paid a foreign tax on it. And this is very important because HMRC have agreements with other countries to be able to get access to that information, and there are penalties if you don't record your foreign income on your UK tax return. So do make sure you're looking at all of your worldwide income. We have got some separate presentations coming up in May and June, which look specifically at individuals, medical individuals who may come to the UK or may be leaving the UK, and what their tax status then is, because they possibly will want to achieve non-resident UK tax status to avoid their worldwide income being taxed in the UK. So keep a lookout for that one. So what's not subject to tax? Surely there's some things. Yes, there are. Again, there are some state benefits. Interest in an ISA account, as we know, is not taxable. If you rent out property, the rental income is subject to tax. But if you rent out a room in your own home, in your property, then there is an exemption of up to £7,500 per year, split if between maybe you and your partner. So if it's above that, then you'd have to put all of it on your tax return. But the rent a room scheme, if you rent rooms in your property, is different from if you're renting a whole individual residential property. Premium bond winnings are not as taxable as interest received would be, and some tax credits. And also, not promoting, but gambling winnings are also not subject to income tax. Now, when we're looking at what tax claims you can make, we're looking at reducing your taxable income. So how is your taxable income taxed? So if you are if you were only earning £12,570 per year, then you would pay no income tax, because that is your personal allowance. That is the amount that every individual, subject to something else I'm going to say later, can earn tax-free. And it's per individual, so it's yours, and your spouse will have one, and you can't use your spouse's and they can't use yours. So independent taxation, which was brought in by Nigel Lawson many years ago. Then you've got the basic rate tax band. So for earned income, this is what we call the basic rate, or 20% tax band, where £37,770, which is between those two bandings there shown, is subject to 20%. Then we've got the higher rate, or the 40% tax band, that now only goes up to 125,140. So you'll see for these two tax years we're showing on this slide, the tax bands are exactly the same, so they're not inflation linked. And actually, the higher rate tax band now stops at £125,140 of taxable income, whereas previously it went all the way up to 150,000, and you only paid the additional 45% of tax rate above 150,000. From 23-24, so the tax year we're in, that's just about to end, you'll pay 45% above £125,140 of income. So, you know, on a like-for-like basis, you will see more tax being due. These tax rates apply to England. You've got different tax rates in Scotland, which you would pay if you had a permanent address in Scotland or you resided in there, assuming that doesn't relate to anyone on this webinar. Just thinking about those tax bands, a few other extra things to say. So interest received, I said before I'd come back to this. So you do have a personal savings allowance. Now what that means is the interest received is taxable, but if you are a basic rate taxpayer and that interest is less than £1,000, it's actually taxable at 0%, so it's allowed. If you're a 40% taxpayer, it's £500 allowance, but if you're a special rate, a higher 45% taxpayer, there is no additional savings allowance. So bearing in mind that we've got more interest expected this year because interest rates are higher for individuals, more people being pulled into that 45% tax band means if you've got money deposited in non-ISA accounts, then you're likely to pay more income tax on that savings. So think about your family arrangements here. You know, if you've got a spouse who is not paying tax, maybe doesn't have any income or is a 20% taxpayer, you know, is the money being held in a bank account in the right person's name? You know, if it's all in your name and you're a 45% taxpayer, can you shift some of that to your spouse and pay maybe no tax or less tax on that interest? If you're trying to think, should I transfer it to my child? There is settlement rules that catch that. So if you transferred it to your 14-year-old child and said, I'm going to put it in a bank account in their name, and then I'll use up their £12,570 of personal allowance, because that's on top of this savings allowance, that's not going to work. It's going to be taxable back on yourself under settlements. It's only if they're over 18 and you're effectively gifting them the money that you would be able to use their savings allowances or personal tax bands, lower tax bands. There's also a starting rate allowance for savings if that person only had other income of £17,570. So again, look at your family arrangements. If you've got a lot of money invested, is there something you can do to reduce your tax on that? Different tax rates also apply to dividend income. Now these tax rates look lower, 8.75% in the basic rate band instead of 20%, or 33.75% instead of 40%. But remember, the company's already paid corporation tax on these first. So actually, companies paid corporation tax on the net sum it's got left, you're paying income tax. So you probably haven't got much of a saving by drawing all of that money out of the company or putting it in a company structure. I believe there's another webinar we have already pre-recorded on limited companies if you had any questions on that. There is a dividend allowance. It's £1,000 in the tax year we're just about to end. So if you have a limited company where you have control over the dividends that can be paid out, then obviously consider paying out a dividend to use up your dividend allowance before the 5th of April, because that's reducing to £500 from the 6th of April. So I think I'm now handing over to Jamie, who's just going to work through, we like a bit of numbers, a tax calculation for you just to see how that will then all filter down, and most importantly, what we can then do to reduce the taxable income. So over to you, Jamie.
Thank you, Lizzie. So partnership income, or if you're self-employed, it can be interchangeable on here, although it is geared more towards partnerships. So if you earn 100 of your profit is 135,000 in the 23-24 year, we've got that on there. That is all subject to tax. However, first off, you can minus superannuation contributions of that. So for this example, we've just used 35,000 just because it nicely brings it down to 100,000. So if you are a partner in a GP practice, the superannuation contributions that you will get tax relief on are the employees and the employer's contributions. Now, if you were contributing to a private pension scheme, such as Scottish Widows or Aviva or something like that, as other pension providers are available, they don't appear at the top bit of the calculation that you see superannuation contributions. They appear somewhere different just because they are treated slightly different. They affect the tax bands rather than getting tax relief at the top bit of the tax calculation. So you get the 135 minus your superannuation contributions come off of there, and then from there your taxable income's 100,000. Off of that, because your income is under 100,000, you get full personal allowance. Now, this was something Lizzie alluded to. If your income does go over the 100,000 threshold, you start to lose this personal allowance. So this amount starts to be tapered away, and I'll show you in the next example actually how much this can cost you by losing the personal allowance. So from there, as I say, your then taxable income is £87,430. That's the amount that's subject to tax, and you start going through the tax bands. The tax bands work on a tier rate system, so it isn't a case that if you're 87,000, all of it is at 40%. So you work through the bands. So the first 37,700 is taxable at 20%, and then it goes on to the 40%. And then after that, also you've got national insurance, which Lizzie hasn't mentioned, but say that's calculated on top. So on profit of 135,000, you'd be paying tax at 31,820. Now, comparing that to the next example, if you did have partnership income or self-employed income of 135, less your contributions to the NHS pension scheme, and then you had other income, and in this example, we've got 25,140. Because your income is now, your taxable income is now 125 and 140 pounds, you have lost all of your personal allowance. So this is all of your personal allowance has been lost at this point. So there's no tax relief, there's no tax-free amount that you get. And you can see here that after that, the tax that you pay is £47,407. This is more than a £15,000 increase in your tax bill just because you've earned an extra 25 grand. So it's a quite expensive place to be for tax purposes. And this is why I say if you are in the band between 100 and 125, it's worthwhile trying to maximise any expenses that you could get relief on, just to try and bring you down so that you don't start to lose your personal allowance. So what can you claim tax relief on? So for GPs, say it needs to be expenses that are wholly and exclusively incurred for the business. So it's got business purpose for it. It can't be, say, something that's personal or private, something like that. I mean, you do have some costs which are a bit of both, and you can apportion those costs as needed. So with partners, we normally prepare a separate schedule of claims, which we call personal expenses, so you can see what they are quite clearly. And if you're self-employed, we normally do an income expenditure as well. So again, you can see all your expenses quite clearly of what we're claiming. For partners, say it doesn't form part of the practice profit, and therefore you won't see it in the accounts necessarily, and you won't see it as a separate element of your partnership profit on your own tax return. It forms part of the partnership tax return. So you say you won't see it in the accounts or your own tax return. It's a sort of a separate claim. You must retain all evidence of claims that you make, and it has to be retained for 6 years, just in case HMRC ever look into it. So what can you claim? This list isn't exhaustive. This is, I say, the most common ones that we see, and ones that most people actually sometimes forget. So you can claim all of your professional subscriptions, MDU, MPS, GMC, BMA, those types of ones, assuming it's not paid by the practice. Now, you just have to be careful that if it is paid by the practice and it's first allocated and in your drawings, I said you might be able to claim it on your personal expense if it's in your drawings. If it has been allocated to you in the first allocations, then it's already reduced your profit for it. So you just have to be careful how the practice is treating it. Telephone and internet. So again, if you're having to use your own mobile phone or your home phone or your internet for doing either CPD, invoicing, anything like that from home, I know there's obviously invoicing for private fees and stuff like that, but reports and stuff like that you can do at home, you can claim a business proportion of those costs. Now, they have to be suitable or acceptable. You can't just claim everything is 100% business use. So you can't just say, oh, all of my mobile phones are 100% business use, because actually you've probably most likely going to have some private use of that, even if it's just scrolling through Twitter or something like that. So just make sure that it is a reasonable percentage that you say is business use. Courses. So if you have to do, as doctors, you will have to do CPD, so you can claim relief for any of the courses that you do as self-employed people. So yeah, all your courses are allowable. Travel to them is allowable, but also travel to home visits for patients and stuff like that. And some subsistence is available as well. So that's sort of, if you're having to stay over for a course or something like that, then say some food and drink is allowable as well. Spouse wages and pension. So if you pay your spouse to do a bit of admin for you or to help with, say, record keeping, you can pay them and get tax relief on your tax return for. However, you just have to be careful, because what you pay them has to be reasonable and commensurate with what they are doing. So if you've got a third party doing that work for you, how much would you pay them? And say it just needs to be reasonable. You do have to be careful though on how much you pay them, because it could mean that you have to run a payroll, and they would have to declare it also on their if it's not on a payroll, they would be self-employed and they would need to declare it on their tax return as well. So just have to be careful with those. You can claim for locum insurance. So assuming that, again, it's not paid by the practice and it's paid by you, you do have to be careful that it's not life insurance or something like that, which just pays out if you're not, or sickness insurance, so it pays out if you're sick. It has to be proper locum insurance. Computer equipment and consumables. So if you're having to use a computer at home, and like a printer or paper stationery, stuff like that, again, if it's for business use, you can claim a percentage of it. Again, probably not 100%, just because there's probably very few things that you use 100% for business and there's no personal use to them. So you just have to be reasonable with those percentages.
Sorry, Jamie, I was just going to come in because we've got a question, but also I just thought it might be just useful to summarise what Jamie's just said there in case this prompts some more questions. So this is not an exhaustive list. We can't predetermine what you're going to spend in order to undertake your GP duties. So we're putting down the more common claims. So we're going to come on to use of home and cars, which are hot topics. But if you've got any questions about any specific items, then do let us know in the chat box. Now, what I normally say to new GPs or our GPs in training that we give lots of talks to is, if you are undertaking something or you're paying for something that you need to do your job as a GP, even if you're going to only use it, I don't know, half the time, like an iPad or some Apple earbuds or whatever, then keep the receipt, give us the information, because it's much, obviously we can then look at the list and say, oh, you can't claim that, or that's, that looks reasonable, rather than trying to guess or, suggest what you may want to claim. as Jamie said, if it's being paid and claimed as a practice cost, then you can't claim it again. But sometimes they're put as drawings. The practice pays for them, but they're charged to your drawings, so they do need to be added onto your personal expense claim. I have noted a typo in this slide, which gives quite a dark undertone about the spouse wages must be reasonable and commensurate with the duties undertaker. We mean not clearly undertaken there. We'll get that corrected in the final set. Right. Also, when Jamie went through the calculation, she showed you how much the tax goes up if you lose your personal allowance. Effectively, you've got a 62% back tax band between 100 and 125,000. This means if you've got an extra £1,000 of expenses that reduce your taxable income, that's £620 off your tax bill. So we're not talking, they may seem like small amounts and you may think, oh, it's not worth putting that in, but these amounts do add up and can come off your tax bill quite significantly. Right, I've got two questions. One of the questions is how much interest relates to the previous slides. How would you work out interest if you had a joint bank account, which is a great question. Anything that's really held jointly between married couples will deem to be 50-50, so just split equally. And the same goes for rental property, unless you've put in place a different declaration to say this isn't held jointly, this is held unequally, and this does relate to property. And I'm not 100% sure, if I'm honest. I don't know if Jamie knows. I don't know if you can do it with bank accounts. I think there may be certain bank accounts you can split unequally. But you can put in place what's called a declaration of trust on property on rental income. So if you've got rental income and you want to keep 10% of it, but you want 90% to go to your spouse, you can say that is how the property is held. If you're married, then there's no capital gains tax issues by effectively transferring more of the share to your spouse. But you can't do it retrospectively. It has to be done going forward, and you have to inform HMRC. So that's a bit of a top tip. Another question is there a certain amount that you can pay spouses? Well, I think as Jamie said there, it needs to be reasonable and commensurate with what they undertake. So, you know, you can't pay a spouse £50 an hour for something that you would pay somebody else £15 an hour for, and it must be something they actually do, or you can demonstrate they do and there's a need for it. It doesn't have to be all in wages, so it may be that some of it's in pension, but the whole package needs to be what you'd pay a third party, really. And where we have had inquiries with that, HMRC have usually allowed something, but not always the full amount. So I'd probably suggest to be a bit careful with it. It's not like the days when you used to do, because I'm so old, the out of hours pre-2004, when they knew the spouse was, you know, answering the phone, taking messages for the doctor's out of hours visits. So I think we're moving on to use of home, if that's okay. Thanks, Jamie.
Need the next slide. Thank you. So use of home. So if you do any work from home, there are a couple of ways that you could claim. One is a flat rate per month, so based on the number of hours that you work from home on average. So they've given a sort of prescribed amount. So if it's 25 to 50 hours per month you work from home, you can claim £10 a month. 51 to 100 is £18, and 101 or more hours is £26 a month. So it's nice and easy. So you don't have to keep all your receipts and work out your business use of your house or anything like that. So a lot of people do go for this. It's nice and simple. However, on top of that, you could also claim for the business proportion of your mortgage interest, rates or repairs to your house, if you do work from home. So the flat rate normally covers things like utility bills, but not your telephone or internet. So we've already covered the telephone and internet costs. So then anything else, say you sort of have to work out your business use of your house for. So HMRC can be quite strict on this, on this type of claim where you're claiming your mortgage interest and rates and stuff like that. So because you don't use all of your house for business purposes, you sort of have to break it down into sort of number of rooms that you do, or square footage if you know the square footage. So if you use one room, like a study to work from, and you've got 7 rooms in your house, you sort of take 1/7 of the cost. And then if you're only doing sort of 25 to 50 hours per month, so you take the sort of 50 hours, which equates to 600 hours in the year over sort of the whole hours in a total year, and you break it down. So if you just looked at your hours instead of rooms, and say, and you only did 25 to 50 hours, the maximum you could claim of your mortgage interest, your rates, repairs to the house would be 6.85%. Some people think it's rather a lot to sort of keep all the costs together, all the evidence, when you're only sort of claiming less than 6% of this. But it is say a claim that you can make. And alternatively, you can do the same. You could, instead of claiming the flat rate, you could claim a percentage of all of your utilities, as I say, as long as you sort of have a good business proportion and you've worked out what those costs are of you working from home.
Sorry, Jamie, I'm back again, and apologies everybody that I'm quite slow on the slides. I'm on the clicking today. So we've got one question, but also just to note that this is not a rental. So, you know, if you want to say, well, I want to, you know, pay £1,000 a month, because that's what it would be to rent an office space, that's fine, but that would be taxable back on you as the home owner and for renting it out. So it's the additional cost of working from home is what the flat rate and those percentages tries to equate to. But the question, Jamie, is what can we claim in respect of fitting out, creating an office at your home?
So again, it's the business use versus personal use. So if you've got an office and you are using it for personal use, you sort of have to weigh up the percentage or the proportion that is personal. So again, you can claim things for like your computer, printer, stationery, like if you've have to buy a desk, drawers and stuff that you have to keep stuff in. So they can all be claimable, and you can have tax relief on them. As in, it just has to be, you just need to know what your business proportion of it, because HMRC won't probably assume that won't accept 100% unless you can sort of say, okay, maybe it's completely separate and it is only 100% used for business. But again, it's demonstrating that, and it is quite hard to demonstrate that. But as I say, normally HMRC are comfortable with something under 100 with that. What I will say is that stuff that's more expensive, like computers or laptops, you won't necessarily see them as an expense. They are capital in nature, and therefore you'd probably get them as capital. They'd be capitalised, and you get capital allowances on them. With capital allowances, it's like a relief for depreciation, sort of wear and tear of the asset. With them, you can normally get annual investment allowance, so you get 100% for the first year, subject to business use percentage.
Yeah, but if you're building an office at the end of your garden, say, there's a structure there, and as you may know, if we've had conversations with you at the surgery, you know, when you buy a building, which is the setting for your trade, you can't claim income tax relief on that immediately. You can claim the costs of things you put in it and things you use, as Jamie's just said, the cost of light and heat and that kind of thing, but not the structure. But again, I think we've got some more details on that if anybody wants anything sent out afterwards. So I think we're moving on, once I've worked out how to click the slides quickly, to the motoring costs. So I'll hand back to you, Jamie.
So motoring costs, so this is something I get asked a lot about. So a nice simple one that HMRC like to use is 45p per business mile. So every tax year, you can claim 45p per business mile for the first 10,000 miles, and then it's 20p thereafter per mile. So that's nice and simple. It's meant to cover things like your insurance, your road tax, your petrol and stuff like that. So it is meant to compensate you for the running costs of your car. Alternatively, you can claim a business proportion of your total running costs of the car plus capital allowances. So what that means is that you add up all your insurance, your road tax, your petrol, repairs to the car, and you apply a business percentage to those costs. Now, what you can normally do is, if you own the car, with this method, you can capitalise the car like you do with a a computer or something like that, you can capitalise the car and you can claim capital allowances on it. Now, cars cannot have the annual investment allowance. They don't get 100% first year allowance, first year, unless they are an electric car, and I'll come on to electric cars in a moment. So normally there's a prescribed writing down allowance, which is based on the CO2 emissions of the car. Now, when you get a car, we will try and do these calculations for you, try and work out which might be best way for you to claim these expenses and which was more tax efficient for you. Now, once you've chosen a method, you have to stick to that method as long as you own the car. You can't chop and change each year. Now, what constitutes as business mileage? And this is where people do get this wrong, is business mileage must be whole and exclusive for the business purposes. So it's home visits, so visits to patients and stuff like that. Home to work is normally considered commuting and isn't allowable. It's not a business journey. Now, some people this might not apply to. So if you are self-employed and doing a lot of locums in various different places, your base of operations is probably most likely your home, and therefore travel from your base of operations to the surgery where you're locuming is a business journey. However, if you are locuming at the same surgery week in, week out, and it's the same day, same number of sessions, then your base of operations is going to be the surgery. So home to the surgery is then considered commuting. So you do have to be careful of what's considered your base of operations. If you were a partner as a practice, your base of operations is going to be the surgery. So say travel from your home to the surgery would be considered commuting and not a business journey. Now, a lot of people will finance their cars when they buy their cars on a PCP, hire purchase, or a flat out lease agreement where they are renting it. You do have to be careful with the finance that you get, just because some of them you technically don't own the car until like the very end, or you might never own the car. You are technically sort of renting the car. If it's a true hire purchase agreement and you're going to own the car, it's in your name, you're going to own it, sort of in the lease agreement, it doesn't say rental or anything like that. Technically, you own the car and you can capitalise the car and you can get relief for the interest on the hire purchase agreement subject to business use. If it's a case that it might be a rental or a PCP, some PCPs do actually get classed as rentals, then you can't, there's no sort of relief for the interest. Instead, you can claim the rental payments for the car, again subject to business use, and there is also a restriction if your CO2 emissions are quite high, so you get a restriction of 15% on that as well. So you just have to be careful, and if it is a rental, so you can't capitalise it because it's not your car, it's not an asset for you, it's an asset still of who you're leasing it from. So I said, you just have to be careful with the finances. We get a lot of people who get confused on those and think that they actually own the car and they don't. Now, this is actually really important if you buy an electric car. So with electric cars, you can get first year allowances. So this is where you get tax relief on 100% of the cost of the car, subject to business use. So again, so if it's 50% business use, you claim 50% of the cost of the car against your profits, and you get tax relief on those. Now, to claim first year allowances, the car has to be new and unused, and either fully electric or with zero CO2 emissions on it. Now, the car has to be purchased outright or with a bank loan, so it's a separate bank loan. If it's under like a PCP, where you're renting it and not a true hire purchase, this relief isn't available. So you need to be owning the car. So that's where these finance agreements do trip people up, because they think they own the car and they don't, and they can't get these first year allowances. So you do just need to make sure what finance you're getting will allow you to get these reliefs. I think there's a question. Would travel to courses of conferences count as business mileage? Yes. So if you're having to travel to courses that are not at your surgery and you have to sort of go elsewhere, or conferences, yes, those are business mileage. Hopefully that's answered that question.
Yeah, I think basically any travel that is not your commute, you know, if you're, as Jamie said, if you're going to your surgery every day, then that's the commute. But going on to visits, going to any meetings, going to any conferences, so that could be a meeting with the ICB, it could be maybe a PCN meeting, a separate practice, could be going to meet your accountant. These are all business journeys that you are making, so you count those in your business mileage if you're claiming the mileage basis, or when you're looking at your percentage. That was great on the electric cars, Jamie, but just to myth bust a little bit, people think I'm going to buy an electric car because it's going to give me much more tax relief. And you're right, you get much more tax relief in the first year because you can reduce your taxable income by the cost of that car, subject to business use percent, and depending if you're owning it or renting it. But essentially, over the life of owning any car, you will get what it costs for you. It's just whether you get it all up front as an electric car, or as you get a little bit every year and a lot at the end when you sell it. So it's a cash flow, I think is probably better to say than maybe something that is a tax incentive. But it could be obviously a tax incentive if you knew you were going to have particularly high profits, and it may take you out of a higher tax band in the year of purchase. Electric cars are very common for people who've got companies because it's a great way of extracting income out of companies, and there is a better tax incentive. But you need an employer to use those tax incentives, and as self-employed GPs, you unfortunately do not have that employer to make use of those. Oh, there is a question. I'm confused about the electric car allowance. Please, can you give an example? We haven't got an example here, so I'm assuming that this individual is asking their GP. So if you buy an electric car and it's going to cost you 50 grand, that's how much it costs you when you buy it outright, and you use it 25% of the time for business use, then actually let's say 50% for business use, just to make the numbers easier. So 50 grand, 50% for business use. So 25 grand, half of the cost of the car, is what you can reduce your taxable income by. So if your taxable income was 125 grand, it reduces to 100 grand. You've then claimed the full cost of that car subject to business use in year one. So there's nothing to claim in year two, nothing to claim in year three, nothing to claim in year four. Then maybe you sell it. So then if you sell it for 10 grand, you're going to have to pay, it's going to increase your taxable income in that year because you've claimed all of the cost in year one, and you can only ever claim the cost of the car, which was 50, less the 10 you got back at the end. Does that make sense, Jamie? Was that a good example, or have you got a better one? Oh, somebody said it makes sense. So that's good. Whereas if there wasn't an electric car, you may only be able to claim 18% of the cost of the car in the first year, subject to business use, and then the same amount, a reducing amount in every other year. But then when you sell it, there may be a balancing allowance to claim. Oh, interesting question here. What about courses and seminars abroad? I feel like that's a definite you, Jamie.
So again, you can claim the cost of the courses if they're abroad. What you do need to be careful of is the travel and hotel. So if you've gone, I don't know, on a 2-day course, but you're there for out there for a week, then you would need to apportion your costs. So basically, if you've gone for 2 days courses and then you've gone to, I don't know, do some touristy things and sightseeing, HMRC won't allow all of the costs of the flights or the hotel. So it'll be sort of the 2 nights that you stayed in the hotel that were relevant to the courses, and then anything other than that would be disallowable.
Yeah, I think as well, you know, just make sure you're going for a course. It's a course you can't get closer to home. You know, if there's one up your road, but you've chosen to go to the one in Miami, then HMRC may query that. But yeah, you've just got to disallow any personal element of that. And one final question is, what about the cost of clothing?
So HMRC see this is clothing as a duality of purpose, because you need to wear clothes for warmth and decency. Not many people would go around with no clothing on, and therefore what you wear to work isn't an allowable expense. Now, there are some exceptions to that. So if you have to wear a uniform, you can claim the costs of replacing the uniform and for laundering the uniform as well. Normally things like scrubs. So I know some doctors will be solely in scrubs, and if they have to launder those again or replace them, they can claim for the cost of those. But if you're just wearing sort of a smart suit or something to work, again, that's not allowable because you'd be wearing clothes anyway. It'd be something as a uniform or scrub. So a uniform is normally considered something with like the surgery name on, or the hospital name on, or something like that, something branded, or like a tunic that some of the nurses and healthcare assistants wear, those type of things.
Yeah, so there was a case, wasn't there? I think it was some barristers who tried to claim the cost of suits, and they were told it's for decency and warmth. Oh, another question, going back to the business mileage. If I work at more than one place under the same surgery, so this is, I guess, got some branch surgeries here, am I allowed to claim business mileage? I'm guessing it's like between the two they're talking about.
It would probably depend on what's in your contract. So normally, I know with sort of us as where we like my base of operations is Colchester. Therefore, if I go to another surgery, another office, I can claim the mileage. So it would depend on what's on your contract. So if your contract specifically says you are at this surgery and then this is where you're meant to work, and you just sometimes you go to the other surgeries, then you could probably claim the mileage. If it's a case that your contract says that you are at all of them, then no. So it does depend on what your contract is, although that would be mostly if you were employed. If you were a locum
or GP
and having to go to different surgeries, again, if you were a partner, it's most likely that the branches are all they're all your business anyway. So again, travel from home to the surgery wouldn't be allowable. I think travel between them would be. So and again, if you were a locum, if you had to, one was there in the morning and then you had to go to a different surgery in the afternoon, that would be allowable, but then home from that surgery home wouldn't be. So you just have to be careful. So normally between them is allowed.
Yeah, I think if you got that situation, maybe make it clear when you provide your business mileage about what each this amount of mileage is between surgeries, or this is to and from, so that we can make sure we work it out correctly for you. Right, are the slides back with me now, Jamie? I think they are.
Yes.
Do keep the questions coming, because we'll have a wrap up at the end, but we're going to move away from the sort of personal expense claim element, and to just then look at some other things that you may be able to claim to reduce your tax or your taxable income. So we've talked about what you potentially can claim, and as we've said, there's no sort of set list. It's got to be wholly and exclusively for the purpose of your business, but it doesn't have to be necessary. It may be, and it's a bit looser than it is for employment. So it can't include private. But if you're doing something which is related to the business to update your existing knowledge, say for courses or training, then it's got a business purpose, you can claim it. Now, childcare costs, probably a lot of you would say it's I need it. It's necessary for me to be able to come to work, but it's not a cost of the business. So although there are some tax allowances and claims you can make, in terms of if you earn less than 100,000, the childcare voucher scheme, you can't claim the cost of childcare, and nor can you claim the cost of private schooling. If you do have private school fees, they aren't allowable in any of your businesses. If a business paid these for you, they would just be taxed back on you as part of your remuneration. So putting them as a limited company expense, if you've got a limited company, wouldn't work either. Quite often school fees are paid by grandparents, and maybe using a trust structure would work for those. Also bring some inheritance tax benefits potentially, and we have some more details in the trust department on that if that's something of interest to you. As Jamie said before, life and health insurance policies and some sickness policies, you can't claim tax relief on those, but similarly, the payouts are not taxable. So you get it both ways. It's not that they're not tax deductible and then you've got to pay tax on the outcome. Entertainment. So this typically would refer to, you know, if you had a season ticket at your favourite football ground and you entertained business contacts. Probably, you know, you're not going to entertain your patients at a football ground, so less applicable to GPs. But of course, you might have some staff entertainment, and that would be like staff parties, Christmas, maybe summer barbecues. There are some certain employment taxes around there and some limits that you just need to be aware of if you are holding any of those sorts of functions. And as we've discussed, any personal element, so a private commute, home to work travel, is not allowable. So what else can I do to reduce my income tax bill? So your pension contributions, if you're in the NHS pension scheme, will reduce your taxable income. That was one of the calculations earlier. This would also include anything that's on a GP solo, or if you do any locum work on a locum A and B form. So keeping track of all your pension contributions you pay, keeping all of the forms is really important, because not only do we want to know the figures to put on your tax returns, but we want to know what your pensionable pay was in each year, because it's going to form part of your pension. And if it doesn't get via PCSE to NHS pensions, then you'll have to produce that paperwork to reinstate it. Now, you do have to watch the timing of pension contributions, because as a GP, self-employed, you'll be aware that there's sort of amounts taken every month from your GMS or PMS income, a pension certificate prepared, and then a catch-up payment or a refund, which will be made potentially in another tax year, maybe another 2 tax years away. And you can only claim tax relief on pension contributions when they are paid. So if the amount that PCSE have deducted is too little, or they've forgotten to take pension contributions for a few months, or you're a new GP and you start in, say, January, and they don't process your change in status, so they don't deduct pension contributions till June, it means that you're not got nothing to pay in pension contributions in that first year, which can cause some cash flow issues. So it's complicated, that whole area, but it's good to try and understand it and keep a record of what the likely outcome is, and keep an eye on those GMS and PMS statements for the PCSE deductions. Although you've got an annual allowed amount, we no longer have a lifetime allowance limit at present. We've still got it on this slide because changing government may change that. You may top up your pension, or you may make other payments into a personal pension scheme, a private arrangement outside of the NHS. Those payments, if you paid £5,000, say, into a personal pension, it gets topped up with basic rate income tax to 6,250 inside, maybe that's SIP or whatever arrangement you've got. That's assuming you're a basic rate taxpayer. If you're a higher rate or a 45% taxpayer, then you can claim the extra 20-25% tax relief on your tax return. So you must tell us if you've got any personal pension arrangements in place, not just so we can keep track of how close you are to the annual allowance, but also to make sure you're getting the extra tax relief, because you may think that it's going all directly into the pot. But we're not financial advisors, so make sure you take the appropriate advice. Other things you may want to consider, or you may be paying for, so make sure you tell us about. So loan interest on business loans paid personally. So you may have bought into the practice working capital, or you may have bought into the property, or both, and you may be paying that loan back personally. That is a loan for business purposes. Your capital is in the business, so you can claim tax relief on the interest element of that, and interest rates are higher now, so there's more tax relief to claim. So you'll need to get the statements or certificate of loan interest for each tax year and give it to us to claim on your tax return. If you have forgotten to do this, you can go back 4 years. One of those years drops out at the 5th of April. So if this is you, then panic slightly and email us straight away afterwards. It's only in respect of business loans. So it's not going to be in respect of your mortgage. And we've talked about being able to claim on the car loans and car finance. But if you've got any loans that relate to things you bought for the business, then make sure you let us know. Gift aid payments work in a similar way to those private pensions that we talked about, where basic rate tax relief is given to the charity. But if you have made a charitable payment under gift aid, then and you're 40 or 45% taxpayer, then there is more that you can claim on your tax return. Make sure you give us the details. If you've forgotten to give us the details and you hadn't thought about this before, we've got those 4 years, as I said before. You can carry this back 1 year. So if you're making gift aid payments after the 5th of April 2024, so say you make a substantial payment at the end of April, that would normally fall in the 24-25 tax year, but you can bring that into the earlier tax year. It may get you more tax relief depending if there's a change in your tax or your income and your circumstances, or it may just be a cash flow benefit. You have to claim it on the first tax return that you submit by January. So you would need to be telling your accountant as soon as, with all your normal information. Don't tell them after the tax return's been submitted. You won't be able to carry it back on that basis. If you've got any losses on other businesses, then you may be able to set those against profits on other businesses. There are certain limits on what you can do, some anti-avoidance to stop you having sort of sham businesses that are making losses. But if you try and run a profitable business on the side, not a hobby, so it's something that you're aiming to make a profit on, but it just happens to make a loss, you might be able to offset that. Doesn't relate to residential rental losses. All you can do with those is carry them forward and set them against future rental profits. Now, most of the things we've talked about last night, and all the things we talked about is, in order to claim tax relief, you have to spend money. So do make sure you're spending money on things you want to spend, rather than thinking about the tax relief first, because you're only ever going to get the tax percentage back. So don't go out and buy an electric car just because you want to reduce your tax if you don't really want an electric car. And don't start, a coffee shop business just because and make a loss because you want it to you want to reduce your taxable income and your tax that you pay on your GP earnings, because overall you will still have less money. And even the investments in EISs or VCTs, so these are specific shares that you can buy and tend to be sort of startup companies, tend to be more risky, but you will get tax relief on them. So you get effectively 30% back. So if you buy some shares, you claim 30% tax relief on the cost of those shares. So effectively the cost of those shares could fall by 30% and you would have not been any worse off. But of course you could lose all of your money because they're risky. And there are certain rules about how long you've got to keep them for, and the interest and the dividends and how that's taxed. They can also be used to shelter capital gains. If you made, although we're not talking about capital gains tax tonight, but if you made a gain on a disposal of an asset. So that's quite a financial advice area again, but something that you can be aware of. I think our last slide is slightly off tangent, but on to child benefit because it comes into tax. I don't know, Jamie, if we've got any questions.
Yes, there was. So if you pay a regular amount to a charity, is it allowable for tax relief?
If it's a UK charity and it's gift aided, i.e. they have to be registered for gift aided, I believe, don't they, Jamie? So
yes, so when you sign up to make the direct debit or standing order, whatever you make, you should be asked to make a gift aid declaration. So as long as you've made that gift aid declaration, then you can claim tax relief on it.
yeah, so that's normally the same if you ring up Comic Relief and donate monies. And you know, if you make money in churches, they normally give you a summary at the end of the year of your donations you made. Not sure how it works when you put money in a bucket outside Tesco's. Probably no evidence there to be able to claim those. Was that all of the questions?
Yeah. Oh no. One's just coming. If I submit an invoice for locum work the 2nd of April but don't receive payment until the 20th of April, which tax year does the income go in?
Well, you should pay tax on the income as it is earned, but I'm assuming if you draw up your accounts till the 31st of March 2024, it would fall into the following tax year. If you draw up to the 5th of April, it would fall into the 23-24 tax year. So the 31st of March and the 5th of April are sort of interchangeable tax and accounting year ends. So it depends what year end you draw your self-employed accounts up. If you've only just started, I would suggest you probably draw your accounts up to the 31st of March 2024, and it will fall into the subsequent year. Are you happy with that answer, Jamie?
Yes. Right, so I think it's our last slide now. So just quickly going over child benefit. So if you do claim child benefit or your partner claims child benefit and you or your partner earn over 60,000, so the rules have just changed from the 5th of April. So if you earn more than £60,000, you do have to do a tax return for a start, and it means that your benefit will get clawed back, and it's clawed back on the highest earner between you and your partner. So even if your child benefit goes to your spouse, but you are the higher earner, it goes on your tax return and it gets clawed back on your tax return. So if you earn between 60 and 80,000, your child benefit will partially get clawed back. If you earn over 80,000, it will be totally withdrawn. So you pay that with your tax liability. For those that have not claimed child benefit to avoid discharge, and as a result you don't have any national insurance credit, so for instance if you've taken a few years off to look after your children and whatnot when they were young, and then you've gone back to it, you might have a few missing years there if you didn't claim the child benefit because your spouse, maybe or partner, was too high a earner. So what you should do is what you can do is you can claim it. The spouse will pay it back on the tax return, but it means you get your national insurance credits for a state pension. So for state pension, you need to have so many years contributing national insurance credits to get a full state pension. If you don't have all of those years, it could mean that your state pension when you come to retire is reduced. So it's just making sure your state pension record, your national insurance record is up to date. And if you've got missing years because you were sort of looking after children and you didn't claim the high child benefit, then make sure that you say it's something that you consider that you should do to get those missing years sorted. But say, seek I have independent financial advice on that as well.
So I think, yeah, I think this is your last call for questions now. Just as a reminder, we'd love to hear your feedback. So after this presentation, you will get a survey that pops up. So we'd really appreciate it if you could answer that so we know we're not wasting our time. And once more, these are our contact details if you don't already know us. So yeah, I don't think there's any more questions coming through, but do email us individually if you've got personal questions following on from this that you would like us to consider. And I think it's just left to say, I hope you found this enjoyable, if that's the right word, and thank you very much for attending.